Well, the optimism came from two places. It came from a softening Fed tone last week, and then from some excitement out of the G20 in Argentina. It deflated when people realized that a trade deal that Trump talked about was all hat and no cattle. There's nothing underneath it. This is a decades-old long trade war, and it's not going to be decided in 90 days. And once people started realizing that, they looked at the economic uncertainties that a prolonged tariff and trade skirmish is going to lead to, and that's why you're seeing a little more pessimism today in the market.
Okay, but yeah, day to day is interesting, but you're not a trader. I'm not a trader. Most of our viewers and listeners, I would imagine, they're not traders. They are longer term investors. They put money in, they hold it, they want to take more money out than they put in somewhere down the road. How is our medium and long term outlook looking? Has it changed at all?
Well, that's a great question, Brian, because what I tell people now is if October made you lose sleep, you just had a few up days, a very strong move last week. If this has been unsettling, now's the time to recalibrate and figure if you should stay in this market. Volatility is going to continue in the short run. But look, we still have a strong economy. When we were talking about the Fed raising rates last week and for the past year, it's because the U.S. economy is strong. And notwithstanding that slight inversion of the yield curve, there's very little out there that's causing recessions to be top of mind for most economists. Most economists are not looking for a recession. So absent of a recession, long-term investors should stay the course because the underlying U.S. economy, corporate earnings, strength of the consumer, all still strong.
Well, darn it, Mark, you must have glanced at my notes because you would have known that the next question was going to be about the yield curve. I know that it's 5 in the morning. It's early. We're talking about yield curves and numbers. It gets a little bit wonky, but it's important. Let's talk about that. The yield curve is the one we care about is not the 3 and the 5 year. Right. It's the 2 and the 10 year. Mm-hmm. That is not inverted yet, but the 10 year is below 3%. Why do you think the bond market and maybe the equity markets, if not telling different stories, may certainly be going in different ways eventually?
Right. Well, the Fed controls the shorter end of the yield curve, and that's why you see it so high in, less than 2 years out, because the Fed has been overly aggressive. The long end weakening, I think, is a result of the slowing global economy. There's some real trouble overseas. I think we're going to have a flight to quality. You mentioned Italian banks. We talked about that on the show. The emerging markets have been weak because of the trade skirmishes, and there's a whole host of issues. There's uncertainty in Brexit. So you have flight to quality, money coming into the Treasury market, pushing our yields down. But you have the Fed being aggressive, and they really need to understand that they've caused a lot of this uncertainty. They've raised the shorter end. I think if we have a better tone from Jerome Powell, I think you see a more normalizing of the yield curve because the shorter end could come down.
Help us make some money. What looks attractive right now to you and your Potomac Wealth Advisors team, Mark?
Well, I think you sit through the short-term volatility. You have to focus on the data and the realities and not the headlines and the news noise. The U.S. economy is still strong. There's no imminent fear of recession. Look at the areas that have been beaten down that may still present values. I think financials still have a lot of value on a relative basis to the rest of the market. And for long-term growth investors, I don't think technology is a bad place to be.